This is More Knowledge, More Wealth with your host, Gabriel Shahin. Gabriel is a certified financial planner and a registered investment advisor at Falcon Wealth Planning. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the services or securities discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. Now here's your host, Gabriel Shahin.
Good day, this is Gabriel Shahin, certified financial planner, and your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. My job is to go over the knowledge you need to increase your wealth. Now, to the listener, you can always reach out to myself or any one of my colleagues here at Falcon Wealth Planning. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can go on our Knowledge Center and get this episode and any one of our previous episodes, whether it's on podcast, Spotify, iHeartRadio, you name it. And our Knowledge Center is fantastic. It links you directly to YouTube. We have a hit video, by the way, on there in just like less than 2 weeks. There's almost 100,000 views on that, so we're pretty excited. And it's how to save $6 million. And I had somebody have a request of a specific situation, and it was actually quite impressive. It was so impressive. I'm like, let me put this into a scenario where you could see online. So check it out if you want to see how you can save $6 million. So if you have a request, send it in to radio@falconwp.com. That's radio@falconwp.com. Now, I'm the president of Falcon Wealth Planning. We're a fee-only, non-commissioned, true fiduciary, folks, and we talk about all important topics of personal finance. You could talk about taxes, investments, estate planning, insurance, folks. You name it, anything that involves a dollar sign, we can help you with. And that's why we're offering 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost to help relate this show to your specific situation. We would love to help. We got offices all over. We can help you out. Give us a call. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird. All right, folks, we got lots of stuff going on here coming up almost to the end of the quarter, Q2, with election season going up. You had Bitcoin that was crashing down, NVIDIA that's crashing down. You have all these things that are going down. Yet the markets seem to be, steady. But I thought it would be interesting just to talk about current events with you folks. And probably the biggest thing here is just NVIDIA. NVIDIA was getting so large where it was bigger than every country outside of, obviously, America. And then you have India, Japan, and China. It was bigger than ever. I actually had to look it up. I didn't believe the Yahoo Finance article. I had to go on there and make sure, is it in fact larger than the United Kingdom? All their companies that they have over there? All their cars and so on, and Germany and so on? I was a little shocked. But sure enough, outside of India, Japan, and China, of course, the US, it is larger than them. It just had me thinking, like, obviously this 10% plus drop that happened, it's just a come to Jesus session with the stock. You cannot continue that type of growth. And I'm just going to say this from the pure supply and demand piece. Right now, they're having so many orders that they can't even fulfill. Well, eventually, Tesla's a great example of this, by the way. Remember, in late 2021, for a Model Y was $70,000. Now, after tax benefit, a Model Y is under $45,000. I mean, you get what I'm saying? Like, look at the difference. That's like a massive difference, guys. That's like a 40% drop in a car of a Tesla, price of a Tesla. Nothing happened negatively to Teslas. We can argue they've gotten better with full self-driving and so on. They've had better products as well. And yet the price of the stock has dropped. The idea here is supply and demand. And with NVIDIA, just thinking about that concept is insane. And then you had more hype when it did the 10-to-1 split. I felt I need to go out there and explain to you how a price of a stock works, folks. Because a split means nothing. Sure, it could be more affordable, but heck, you do know through your broker, your custody, your discount broker, whatever, your Fidelity, Schwab, E-Trade, whoever, you can buy fractional shares, right? You can actually, if it's $1,000 a share, you can buy $10 worth of it if you wanted to. With your custodians and your brokers that you're working with. You don't have to buy a full share. But needless to say, it had a 10-to-1 split. So let me just tell you what that means. Let's say, I'm going to use easy numbers here. How does this work? Let's just say a company has 1 billion shares, okay? And the company's worth $1 trillion. In NVIDIA's case, let's just say had 3 billion shares and it was worth $3 trillion. How much is the price per share? The difference between 1 billion and 1 trillion is 3 zeros. 3 zeros is 1,000. So if it's your company, in this case, NVIDIA, is worth 3 trillion and you have 3 billion shares, it was 1,000 a share, which is kind of roughly around there. Let's take it a step forward. Well, now they're doing a 10-to-1 split. So now you don't have 3 billion shares, you have 30 billion shares. The price of the company hasn't changed. It's still worth $3 trillion, which means it's now not worth 1,000 a share, but 100 a share. This is where some people kind of lose sight of this. It doesn't make sense. So they don't understand the background behind how any of this works. They just go ahead and buy the company and say, look, it's lower. I kind of joked. I should have done like a social media post on this, like, oh no, I lost 90% of my value. It used to be $1,000 a share. Now it's only $100 a share. It's kind of funny, right? But this is how some people truly think. Thank goodness our clients are more sophisticated because we've trained them to be more sophisticated on that. So they didn't have to worry about that. But the idea is that people are chasing crazy things. I look at the GameStop, for example. Remember what happened last weekend? It was kind of uneventful last Friday when all those shares through Roaring Kitty expired. Nothing really happened. Good for him. Proud of him. He made some money. Caused a whole lot of ruckus. But look how stupid some investors are. There was so much that came through on the GameStop where people were still buying them. GameStop was able to pay for their debts by issuing more stock. Now, what should happen when a company issues more stock? The price should drop. Why? Well, because if the value of the company doesn't go down. Now, if you do a split, the price adjusts for that split, right? If you issue 10 times more stock, the price goes down, right? Exactly to that ratio. Or if you are not doing a split, for example, if a company, I can use NVIDIA, for example, let's just say, remember it was worth 3 trillion, and you have 3 billion shares. Now you have 30 billion shares, right? So that means the company is still worth 3 trillion, but the price of the stock isn't 1,000, it's 100. Now check this out. Let's just say that instead of having 30 billion shares, they issued another 30 billion shares. Okay, so now the price of the stock theoretically should be cut in half because the value is still $3 trillion, but now you have double the amount of shares. It's your market capitalization versus the amount of issued shares that is out. Whatever the company's worth is the market cap. It's crazy. GameStop realized how stupid these investors were, how idiotic these morons were for buying this stock. How stupid they were. They issued more stock. They got money from the stock because the moron investors kept buying them. They kept issuing stock so much on the price. What did these idiots keep saying, including Roaring Kitty keep Gill, and kept buying more shares like an idiot? What did he keep doing? He's like, oh, the price dropped. I'm going to buy more. He doesn't even understand. Nobody understood of these meme stock buyers of the core characteristics of a stock and investments in the markets and finance and economics. So much so, the CEO of GameStop took advantage of all the morons that were out there and paid off all the debt of the company and put cash in the bank. I mean, that's good management. The hell with these idiots over on these meme stock buyers, Robinhood and Reddit people out there. They're idiots. Now, I will say there's times the idiots made money, and I'm happy idiots made money. Everybody deserves to make money. Heck, a broken clock is right twice a day. You saw that with Hertz. The damn thing went bankrupt. So much Hertz is looking around like, what are these idiots doing buying their stock? Issued more shares. We're paying off their debts. So much so a private equity firm came and bought them for 16x what they were trading at. So the idiots made 16x during the whole COVID craziness when people had that extra stimulus check in their pocket. It's just crazy to me. By the way, folks, you're just joining me. Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth here on every weekend, talking about all important topics of personal finance. I'm just going on this topic of NVIDIA. and I'm going on the topics in general with just investing. And the things that I'm seeing these days is just insane. And it just makes no sense. And it's normal for these type of come to Jesus realization session, because naturally, when the orders aren't so long and the waiting list isn't so much, then yeah, the price comes down. They cannot keep selling it at the premiums that they are selling it. And then I see the same logic with SoFi. I mean, SoFi, what are they? They're like a debt issuer, kind of becoming a bank now. They service a lot of student loans. I get it, right? A lot of people use them. I respect it. Hey, they have a SoFi Stadium that's named after them here in Southern California. I get it. But they're losing hundreds of millions of dollars a year. I mean, say what you want about these guys, but they're losing a crap load of money. And it's just funny because now I go on social media. I'm pretty active in Twitter now. Had some pretty popular tweets. So please look me up, Gabriel Shahin, Falcon of Finance, however you like to say it. And so the idea here is why some of these people are actually naturally saying the fundamentals are strong on this company. I don't get it. In 2023, they lost $300 million. Sure, their revenue went up, but who cares? They lost $300 million. Like, I get it. Last quarter, they actually had a net profit. Like, I get it. But don't tell me their fundamentals are good. I mean, I can actually prove that quite simply. They're saying their balance sheets are good. I don't quite understand. When you look at 2022 to 2023, so their revenue, right, or we'll call it their assets are up 50%. Okay, assets up 50%. Good job. I'm proud of you. But their liabilities are up 85%. Where do they see that's good fundamentals when their debt is growing faster than their assets? I don't understand that. I don't understand where people are saying their balance sheets are good. It just blows my mind sometimes when I see some of these specialists on social media talking. They are idiots and morons, like the same idiots and morons that are buying GameStop. I mean, it's crazy to me. Everybody's trying to get that emoji that's to the moon. I get it. Who doesn't want to make a bunch of money? But don't be upset when you lose a crap load of money. The amount of risk that you're taking blows my mind. And we're seeing it quite often. And when you look at the amount, the returns that the stock market has achieved this year, which is over 10%, and you see that a majority of those returns have come from the Magnificent Seven stock, you have to start thinking to yourself that, are we in some type of a bubble? Now, I hear that a lot. People are comparing the amount that this tech has, the core Magnificent Seven has, compared to what it was in 2000 and during the dot-com bubble, 2000, 2001, and 2002. But you have to understand, these companies are making money. I mean, when you look at Apple, Amazon, Meta, Google, Microsoft, Tesla, and NVIDIA, they're making money. Their net profits, billions of dollars. So it's hard to say, what, is there a crash coming? How? They're making billions of dollars. And when you look at their PE, the price of the stock, versus their earnings, what they're making, you don't want to overpay for something, right? If it's making, let's say the price of the stock is, let's just say $50, and it's earning, let's say $5 per share, that's a 10% ratio. That's a good deal. You're buying a stock at 10% of the value, not even considering the cash that they have or assets, that's a pretty good deal. Most of the time, it's in the 20s. We're going to go on a quick break, and we're going to discuss more in this second segment here of these price to earning ratios. Now, that's not the only indicator. I get it. But it's a good frame of reference just for the novice, just for kind of the norm, and just a basic understanding of where things are going. We're going to look at the price earnings ratio and specifically the forward PE, because a lot of people do not look into that. Folks, we'll be right back after a few words. This is Gabriel Shahin, Certified Financial Planner, your host of More Knowledge, More Wealth. That's on every weekend. We're going over all important topics of personal finance. We're going over retirement planning, making sure you're prepared for retirement, Social Security and strategies, real estate, taxes, avoiding them now and in the future, investments, reducing fees, commissions, and so on, insurance, and estate planning. Folks, we are offering a free financial assessment that you could take advantage of. We have offices all across Southern California, including the Inland Empire. Give us a call to take
take advantage. Our phone number is 855-963-2526. That's 855-96-FALCON, like the bird, or visit our website, falconwealthplanning.com. That's falconwp.com for short. Enjoy the show. We look forward to serving you.
Welcome back, folks. This is Gabriel Shahin, certified financial planner and your host of More Knowledge, More Wealth here, and every weekend talking about all important topics of personal finance. Today, we just thought we would have some fun, and we started talking about some stocks. We talking about meme stocks. We talked about what's happening with NVIDIA and how the price has retreated, and then Bitcoin even, how it's retreated. These are all normal signs, and we get it. There's a lot of people that have extreme inflows of money who bandwagon a lot of things until we get it. Over time, there is a come to realization piece to it. But to think these companies are bad, our investments are bad, that's a whole other thing. I just went over SoFi. I was on social media, and the amount of posts on SoFi is insane to me. This debt management company, this financial company that's out there, who, yes, has tens of millions of clients, but at the same time is not financially strong. This would be considered a risky investment. Just because, based on a SPAC, a SPAC is just a company that took a bunch of money, was trying to take company, investing in companies, trying to make it public. This was one of the famous ones that were out there, and it's crashed. We're talking probably 95% down from its high, would be my guess. And the idea here is people still think, oh, well, it's going to go back up. Why? Just because you know the name? You see them on a stadium? Companies have to make money, folks. You know what they call companies that don't? That consistently lose millions and billions of dollars? Zombie stocks. The banks just continue to refinance their debt because worst case, they're going to lose the money anyway. So the debt that's coming due, they're consistently refinancing that. Hopefully they can find some suckers to keep buying the stock and they issue more shares. Doesn't affect the price of the stock because you keep pumping it up and they pay off all their debt. That would be a great scenario. Man, they should invest in like Reddit. They should have like, man, if I guess it's probably SEC. It's not allowed. But, find like an influencer and say, please pump this stock up just like you did with the GameStop and AMC. And hey, maybe we can have idiot kids like invest, a million kids, $100 each. That's nice, $100 million, and we can pay off some debt. I wonder if it works that way. I'm sure it's an SEC violation because it's manipulation. But heck, I don't know. Maybe they can invest in a really good commercial to target these kids to invest in them. That's not market manipulation. I don't know. Kind of interesting to me. But needless to say, you have people taking a ridiculous amount of risk. So I thought, as I went into that example earlier, talking about issuing shares and buying back stocks and so on. And remember, a lot of companies think to themselves, CEOs, they get paid based on their share price. It's as simple as that. And so a lot of them buy back shares, not because they think that's the best investment possible, but when a company buys back shares, that's less outstanding shares based on the same value of the company. That doesn't change. But because the value of the company doesn't change, there's less shares. Share price, it's basic math, folks, has to go up. This is why you see a lot of Fortune 500 companies buying back shares, their own shares, because the price goes up. And what is the what is the CEO based his compensation on? The stock price goes up. So this is extremely important, why you sometimes see that happening in Fortune 500 companies. I'm just trying to share with you basic concepts here of what you are seeing. And by the way, a 10-to-1 stock split and the company drops in value, right? It goes from $1,000 a share to $100 a share. It doesn't affect the SEC. At that point, it would be based on market capitalization, also known as the new stock price, right? So it's just funny because the dilution of shares, what is the dilution? That is when a company just issues shares. As a shareholder, you should hate that. But if you're a GameStop holder, I guess that's fine. You like losing money. I'm proud of you. It's a form of donation, except you don't get a write-off. Maybe you do. You get to write off $3,000 a year. I take that back. You can do it. Maybe you just really like GameStop. You want to lose money. You get a capital loss, which is good. You capital gains. You get to write off $3,000 a year. Maybe that's what you want to do. I have no idea. I stopped trying to think of what you guys are trying to do. I just thought I'd tease it and make fun of it here on the show. So I want to focus a good amount of time right now on the Magnificent Seven. People are saying it's too expensive. This could be the next. I almost said 9/11. That was a bad time, but people remember that because it was 2001. That just added more negativity with markets and so on. Heck, they closed the stock market for a week when that happened. Extremely sad. But when you look at the dot-com bubble, they say the dot bomb, right? The tech wreck. So all these names for it. You have to look at why that happened at the time. Yes, 50% of the market almost was tech companies. You're kind of seeing that now, even though Amazon's more consumer discretionary and a few other these companies as well. But when you look at Apple and what they're currently trading at, what their forward PE is, their forward price to earning ratio, okay? And this is as of June 21st. Okay, this is the Friday, June 21st. When you look at that, it is based on what the projected earnings per share will be. You ever see the earnings was missed? Earnings was made. So this is analysts already saying, and you've seen this with a stock. Sometimes a stock will beat earnings and the stock price drops. Apple's famous for this, by the way. Why? Because the analysts thought it's going to beat earnings by a higher percentage. Because remember, that stock price is based on what the expected future earnings are of that stock. So if it beats it but doesn't beat it by as much as we thought, that's why the price drops. It's kind of crazy. You really have to know what you're doing. This is why it's important to truly try to get as much knowledge as possible. Not these morons. I keep saying morons. I feel bad. That's an insult to morons, I'm sure. But needless to say, you really need to get actual unbiased advice, not people trying to get followers on social media. Who's to say they actually know what they're talking about? Even the professionals on there. Who's to even say? I mean, I'm trying to share with you with basic knowledge and basic concepts to give you knowledge to make an educated decision. I mean, it's logical, everything that I'm saying. It's practical, and more importantly, it's basic economics. That's all I'm trying to bring up right now. So when you look at the forward PE of a company like an Apple, they're trading at 28 times what they're making. 28 earnings, that's a PE, price of the stock versus what they're making. Historically speaking, for a tech company, it's about 35. They're still at 29, right? Remember, their growth trajectory is a lot faster than a McDonald's, than a Walmart, than a Pfizer, right? You get what I'm saying? So their growth focus is much more. Sure, they bombed on the goggles that they made, the headset, but they're coming out with more items with AI and a few other things that really the market likes. So when you look at a 28 PE, that's not that expensive. Let's look at Amazon. Remember, the price of what they're trading at versus what they make. They're at a 40x, 40 times. So there's a couple ways to look at that. They have to be in business for 40 years to make what they're making in 1 year, right? So that's a 28 is better. You want a lower number. It's more value. Look at it this way. If you were a multi-billionaire, trillionaire, okay? Apple nets every year, let's just say 50 billion, and they're trading at 100 billion, you're going to make your money back in 2 years. That's a 2x PE, just from the basic concept, just so you understand. That's a great investment. The lower the better. You make your money back in 2 years, that's a 50% rate of return. You get what I'm saying? Versus 100x PE. If you spend $100 million for a company that only makes you $1 million a year, why the hell would you do that? That's a 1% rate of return. What's still risk of operating a company? What if there's negative news? What if there's a recall? What if there's an accident? Bad press? You get what I'm saying? So this is why it's important. Amazon's a 40. Interesting. Some would say they're expensive. Meta, Facebook, right? 25. Google, 24. Microsoft, 33. Remember, they were the largest company in the world. Maybe now they are, with NVIDIA dropping. Apple was for the longest time. I said Microsoft, 33. Tesla, get this, 74. They're kind of expensive. Why? Because their future growth is very high. They were at 50% year over year, what people were expecting them to grow. This forward PE, folks, is over 12 months. So they're still expensive. This is why some people are a bit uneasy with Tesla. And then lastly, NVIDIA. After all this hoo-ha, they're at a 48. Expensive, but remember, their growth trajectory is pretty high as well. These are the things that people just don't realize. This is why we say it's important to talk to a financial professional. This is why we're offering a free financial assessment, where we're giving you 1 to 2 meetings, 1 to 2 hours of our time, folks, at no cost. We would love to help relate this show to your specific situation. Take a look at what you're invested in. Take a look if now it's time to divest. Take a look if now time to add more. Take a look at multiple different ways of how you can reduce taxes. I've seen people not sell for tax reasons just so they now have lost the wave, lost their money, and it dropped all the way back down to their original purchase price. Don't let the tax tail move the money dog. You have to make sure the goal of investing is to make money, and paying taxes sometimes is a byproduct of it. And if you're lucky, you plan ahead where you can help legally avoid taxes. These are the things that I just know people are not doing. Why? Because they typically come see us after the fact. If you're listening to the show, you have an interest of money. And by the way, people that have an interest of money sometimes have money. So do not wait. Reach out to a professional who can help, who understands these concepts, understands how to analyze companies, plus to analyze your specific situation with stock. Because if you talk to only a professional that understands money and investments and stock, they don't care about anything with your situation. All their attention and time is focused on investing. But personal finance is more personal than finance. You have to relate it to you. This is where we would love to help. This is where we want to add value. This is where we want to take a look at your situation, because we've seen it thousands upon thousands upon thousands of times before. And we can help. Use that experience, use that expertise to save you some dough, because we see it time and time again, folks. I mean, I'm taking little notes here just because of these numbers. I don't like going over that much numbers on a show. Sometimes it can hurt your head. You'll lose it a little bit. And I get it. And I respect it. Because when you look at investing, your main goal is what? To make money. But what made you money yesterday may not make you money tomorrow. These are the things you have to take a step back and understand. Folks, that was a fast show. I want to thank you for tuning in with me. You can always reach out to myself or any one of my colleagues here at Falcon Wealth Planning. Our phone number, 855-963-2526. That's 855-96-FALCON, like the bird. Or visit our website at falconwealthplanning.com. That's falconwp.com for short, where you can get this episode, any one of our previous episodes as well, and check out our Knowledge Center. We have some fantastic videos, some great information on there that we got from you, from the questions that you asked. So if you got a question, go ahead and send it into radio@falconwp.com. That is radio@falconwp.com. Folks, thank you for tuning in. I want you to enjoy your weekend. Have a great week, and God bless.